Alright, welcome back everybody. So in the first video we covered what is expected move, implied volatility, and IV rank. And in this video we're going to talk about how can I use that expected move in a weekly trade. So I want you to just give this a little thought for a moment. These lines on the chart. If you knew in advance what a market is expected to do next week and its boundaries that it could run, what could you do with that information? Like seriously, guys, give this some real thought because the accuracy on these trades are impressive. And when it starts to lose that accuracy and it starts to break down, then you can take the other side of the trade and say, all right, you know what? They've been missing a lot. I'm gonna take a bet on them actually not staying inside of the range. But if you have a clearly defined range like we do right here, you know exactly where it could go next week with a high probability. What would you do with that information? And keep in mind, next week is actually a short week. You can see on my chart that we're at the end of June, which means 4th of July is right around the corner. And next week there are only 4 days showing. And so it's going to be a shortened week. Even inside of that shortened week, we've got a really good distance marked out here from 309 to 290. All right. If we just round that up and say 310, we've got a $30 expected move here. $15 higher, $15 lower. You know it could move inside of this range, even peak out a little bit from the top or the bottom and still close inside there 70% of the time. Now, what do you want to do with it? With options, we can trade long, we can trade short, we can trade neutral or sideways. What can we do with this? So one of the things that we can do is we can trade fade logic. Now, fade logic doesn't have to be some complex thing. The idea behind it is that when a market gets to the edge of its expected move, like it did here in this situation, we immediately take it back in the other direction, right? So this was the expected move for that week, and you can see it broke to the downside on that week. We would have taken it long on faith that it would come back inside the expected move, and it did. Now, can you do that every time? Can you expect to take these kind of trades and never lose? Nope, doesn't work that way. But for the most part, 70% of the time, and actually it's more than that, but by the numbers, 70% of the time, we're going to close inside of this. Here again, we broke out to the downside. We came right back up and closed inside of the expected move. Here we actually failed, but it certainly tried to get back down there and close inside of the expected move. Okay, so what could we do with it? We could look for a market to break out of its expected move and immediately put on a trade to take it back in the other direction, just like we would have done here. It broke to the outside, we take it short, and we close it on the inside, right? So that is one way to do this. We could fade the expected move. It's fade logic. We could also run breakout logic. Now, when would we want to do that? Maybe if it's breaking out early enough in the week, like it did here. You can see that on Monday, the very first thing that it did was run right out the door. That would be an opportunity to trade a breakout. Now remember, we're not trading directional. We don't care how far it goes. We just care that it doesn't come back and hurt us, right? We're going to get into the style of trades later on. Butterflies, unbalanced butterflies, iron condors, verticals, back ratios, you bet. We're going to dig into all of those because every single one of those could be applied. But right now, let's just talk about what we can do with this knowledge. We've got a box around price with a high level of accuracy. What are you going to do with it? The third thing that we could do is boundary logic. So we've looked at breakout, we've looked at fades, and now we're going to talk about boundary logic. If you know with a high degree of certainty that price is going to stay within this box, you could put on a credit spread. below the market, above the market, and expect it to stay inside of this box. All right? Iron condors come to mind, unbalanced butterflies, all of that, right? So we can do that. Heck, depending on your broker, you could put on a double butterfly. Put a butterfly here and a butterfly there. And then if it's still inside the expected move by the end of the week, you convert the double butter into an iron condor and you still win. So that's boundary logic, okay? We've had fade logic, breakout logic, and now we've had boundary logic. And just like that, we have 3 different tactics that we could use on these expected moves. Now look, guys, you don't have to just do it for a week, right? You can do these for 2 weeks. You can do them for a month, 3 months, right? 3 months really is the edge of the line, you know. And once you get past that 90 days, you really get into that level of options where things just start to move like molasses. And we just want to avoid all of that, right? But 3 different ways that we can apply this. And in these videos, we're just talking about trades for Friday. Front options trades. We are looking only at the most current Friday. So July 2, because of the holiday, we don't have a Friday trade, right? July 2, or if we jump over to the Qs, because we're not stuck with just SPY, we go over to the Qs, we got July 2, right? That's next Friday, and that's what we want to be focused on here, okay? So let's see what else we got. IWM. Okay. So these weekly trades are where it's at. This is a way for you to keep that capital rotating. And if you're in a small account, that is key to growing your small account. You cannot get your funds tied up into a trade that takes months or weeks for you to finally start to rotate that capital around, right? You have to be able to close down the trade, get into a new one, close down the trade and get into a new one. Now, one of the reasons why is because of the fact that to go from 0 to 50% credit, you might be able to hit that in 2 days, but to go from 50 to 75% on a credit spread, it might take you another 5 days. Well, in that 5 days, you could have already closed down and opened up a new trade, hit 50%, closed that down, opened up a new trade, hit 50%, and then finally gone back to that other trade, which went from 50 to 75, right? So the time it takes to go from 50% profit to 75% profit is almost twice as long as it took for you to go from 0 to 50% profit. You gotta keep that capital rotating. Trade small, trade often. For a small account broker, or if you have a small account, you don't have much choice on the size. So trading small is already in your wheelhouse. Trading often is what you gotta focus on. Getting a trade shut down and opening up another one. Always looking for the next trade. What am I going to get into next? How long am I going to be into it? Game it out. Game theory 101. What happens if? All right, so we have 3 trades that we can look at. Between the choices of those 3 trades is how you can take your account and grow it out. If we only focused on the indexes, then you options traders are going to be focused on the same thing that the futures traders are focused on. The S&P, the Russell, the NASDAQ, the Dow. Your ability to trade exactly the same product that they're trading is critically important. It's highly liquid. It's got structured moves. There's no earnings to deal with. You do got dividend though, so pay attention. Don't let that dividend come back and kick you in the butt, because I don't want to hear when you start crying, "Sig, I got dividend." Yeah, that sucks. So, okay, look, we got fade logic, breakout logic, boundary logic. If we're stalled and moving sideways, look at a boundary trade. If we're strong and aggressive moves with a lot of news and volatility, take a breakout. If everything is just a normal, continuous, slow grind, take the fade logic. Do not bet against yourself. So if you go long in SPY, don't go short in the Qs. If you go long in Dow, don't go short on the Russell. Statistically, you're shooting yourself in the foot. So if you're long in the indexes, be long. Maybe go neutral and long, or neutral and short. But don't bet long one way and short the next in the same week in two different products, because one of those is almost guaranteed to lose. There are trade setups for that, by the way. It's pairs trading or hedging, but it's an entirely different thing, and the profit margin is so very small. It's not worth it, especially if you're in a small account. Okay, guys, so now we've got 2 videos on this weekly trade series. You know what expected move is now. You know what implied volatility and IV rank, and now you've got 3 different tactics to trade a market with a defined range. I'll see you in the next video.